those that don't know Plato, I assume most of you do, you're probably expecting to see my fearless leader Don Hampson up on stage, and probably the fund you're most familiar with would be the Australian Shares Income Fund. But Plato's been around for a long time, have $16 billion under management, and has been around since 2006. And in sort of the last half of that time period, Plato's been very quietly but consistently building a global equity presence. And so now, of that $16 billion, $2 billion is in global equities, and obviously we're looking to grow that. And the specific fund that Mark was nice enough to mention is the Plato Global Alpha. We invest in global developed equities. Our focus, the benchmark we're trying to beat is the MSCI World Benchmark. It's a 150-50 strategy, so for those unfamiliar, it means for every dollar that you invest in the fund, we go long $1.50 worth of stock, and we fund that by going short 50 cents worth of stock as well. It means we always have a 100% market exposure. So that means that this fund can be a core allocation in your portfolio. The actual return volatility of this fund is almost identical to the benchmark, but I'm pleased to say that since the fund's inception, we've managed to handsomely outperform that benchmark. In fact, in 2023, the fund achieved a return of 32%, and year to date, just in the first 6 months, we've achieved a return of 27%. And since inception, which is September 21, we've outperformed the benchmark by close to 10% after fees. And as Mark mentioned, we're really looking for an all-weather approach to our performance. So that's a sort of a hallmark. That's the North Star of this strategy. It's a very important part of what we do. I should mention, you might look at this and go, you guys have only been doing this for 3 years, you haven't earned your stripes. And I should mention that our lead portfolio manager, who has come from JP Morgan, that's David Allen, and he was at JP Morgan running a sort of similar fund for 10 years. It was a European equity strategy, 130-30, and a lot of the DNA of the existing strategy really came from that. And you can see the chart on the left shows the fund performance, which is the black line, relative to the benchmark. You can see consistent outperformance during that period. And the chart on the right shows the cumulative active return, which is the green line, relative to a lot of the competitors, the 40 largest global equity funds at the same time period. And what you'll notice is that investors enjoyed a very smooth active return experience with his fund. And the only funds that sort of achieved similar returns, it was a lot more volatile, it was episodic. So that's something that, again, highlights what we're trying to aim for. This all-weather approach, consistent alpha. We're not trying to hit sixes, we're just trying to get consistent singles. And we've been talking about whether it's a good time to buy value or is it a good time to buy growth. Well, what are the fundamentals telling us? And there's been a lot of discussion about that today, so I can get through this quickly because I'm not as smart as a lot of the guys who were up here earlier talking about this. Basically, value looks really cheap right now, but maybe it's cheap for a reason. All the excitement's been in growth, right? Everyone knows that, the Magnificent Seven, AI, there's been a lot of excitement about that. So it's a tricky environment. Some people are nervous about growth stocks. They sort of go, well, it feels a little bit like the tech boom in the late 90s, but the one significant difference is that unlike the tech boom, a lot of these big growth companies are producing a proverbial tsunami of free cash flow. It wasn't like Pets.com in 1999, which had a market cap of 500 million on $5 million of revenue. We're seeing a lot of companies generating billions, tens of billions of dollars of free cash flow. So look, the case for growth is very compelling, as is the case for value. So the question is, which one do you choose? Well, we don't think you need to choose. In fact, our view is, it's bloody hard to choose. So our view is, why don't we pick the best of value, the best of growth, and the best of quality? And the way we do that, the beauty of investing globally is we have 10,000 stocks that we can look at. And we take advantage of close to 1,000 different data sources. And so we look at value and growth and quality on an industrial scale. We're sort of measuring value and growth using a variety of very sophisticated and very nuanced definitions daily using these databases. So we have a view on all 10,000 companies and it allows us to pick the very best of value, the very best of growth, the very best of quality. And the beauty of that is you can actually build a really diversified portfolio and one where you can have hundreds of stocks, but given you've got 10,000 stocks in your universe, there's still your very high conviction views in each of those factors. So that's what we try and build. So I've got a few examples here, but remember, we're very diversified. These stocks will only be a very small part of our portfolio, so they're more for illustrative purposes only. In the case of a sort of poster child for value, we have BMW. A little bit like what Vihari said regarding Hyundai. It's trading on a very low PE, 5 times PE compared to Tesla, which is on a much higher PE. It's actually going through the process of electrifying its entire range of vehicles, and it actually sells a lot more electric vehicles than you might realise. In the case of a growth stock, a classic is Eli Lilly. That's obviously very big in the anti-obesity drug market. Now that's a market that's expanding rapidly. There have been some concerns about increased competition of late, which has meant that share price has softened. However, this market we believe will continue to grow rapidly. Could be a $100 billion revenue market by 2030. And Eli Lilly, as well as Novo Nordisk, were really the first entrants in that space, so they'll sort of benefit more than others by that growth in the market. So that's a sort of a classic growth stock that we might invest in. On the quality side, a good example is Rolls-Royce. That's a brand that's synonymous with quality. They've really benefited from an explosion in defence spending of late. That stock's up over 200% since we bought the stock just over a year ago. And I should mention, when it comes to value and quality, we talked about growth traps, talked about value traps. The real key is looking for quality. You need value that has quality, you need growth that has quality. That's why quality is a very important part of our process. Okay, so what does that all mean? Well, the proof is in the pudding. This chart shows the performance of the Plato Global Alpha Fund on a monthly basis. Now, these are excess returns. So our benchmark is the MSCI World. So if that blue bar is above 0, it means we added value relative to the benchmark. If it's below, we detracted. And so this is since the fund's inception. And you would have all seen charts from my colleagues where they show that clearly there was a bit of a break point at the start of 2023. Prior to that, we were in a very strong value environment, sort of a bear market. Things weren't looking good for growth stocks. They got hammered. And then from 2023 onwards, much to people's surprise, all of a sudden there's a discussion about AI, machine learning, the Magnificent Seven. They were off to the races. And what's really exciting about the returns that we have given our clients it's been a very smooth return journey. You can see the active returns that we experienced during the bear market, during a value environment, look pretty similar to the active returns that we were able to give our clients during the growth environment. And that's really by, as I mentioned, we're combining the best of value, the best of growth, the best of quality to give this all-weather alpha, so you don't have to decide. Another thing that I haven't really spent much time on is talking about the fact that we're 150-50 means that we can take advantage of companies by shorting them. We look for overpriced companies, and this chart shows the contribution that we've received in the fund from the long side versus the short side. You'll notice that the shorts have actually been the biggest contributor since the fund's inception. Now, that's not what we would expect in the long term. However, a lot of that short contribution came in the first half when we were in that bear market. That was an environment where we saw global interest rates rising at a sort of a generational speed, and as a result, we saw a blowtorch being applied to a lot of valuations of growth companies. As a result, we were able to identify a lot of those companies, and they were in the short portfolio, and we were huge beneficiaries from that. And from 23 onwards, you can see more of an even contribution from the long and the short side. That's what we're more likely to expect in the long term. So there's a real advantage to being able to include shorts in your portfolio from an alpha perspective, but also from a risk management perspective, because you can sort of balance out any exposures in your book. If you're sort of really long one sector, you can go short that same sector, so you're not going to be buffeted around by macro events as well. That's why we can, again, achieve that consistent outperformance. Another thing that helps us identify shorts is we have a very unique part of our process called the red flags. This is the idea where we look for any sort of red flags you might see of a stock around forensic accounting, governance, that just on its own may not be that concerning, but when you monitor over 150 red flags and you see that a company has lots of them, it really spells disaster, and you can take advantage of that on the short side. We typically find that if any stock in our universe has more than 8 red flags, they will typically underperform the market by close to 20% in the next 12 months. And that's something we take advantage of in our short portfolio. So that's pretty much it. The headline is we've achieved a 19% return since inception. That's close to 10% above the benchmark, with very low risk relative to the benchmark. Really symmetric upside and downside capture. Again, really targeting consistent returns. And I'll leave you with this final chart, which shows our return experiences for clients relative to the 40 largest peers. We're second out of 318 funds in the Morningstar Global Universe. So we're pretty happy with that. It's been a very smooth return experience. I'll leave it at that.